Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in Mortgage Today, our weekly walk through all the latest happenings, news, kind of assessment of the current business climate for the mortgage industry. And each week I am pleased to be joined by one of our lender members as my co-host. And this week, one of my favorite TMC members, repeat co-host, the Chief Mortgage Officer for Right By You Mortgage, a division of Fidelity Bank out of North Carolina, Melissa Langdale. Melissa, thanks for joining me.
Absolutely. Thanks for having me, Rich.
Awesome. So let's get right into it. Before we do, though, Right By You Mortgage, a division of Fidelity Bank. Tell the audience just a little bit about Right By You, your mortgage lending operation, and anything that makes you unique or that you have that's notable in the hopper as we get into the heart of summer here.
Yeah, so Fidelity Bank is about a $3 billion community bank. We're 112 years old now. And, but from a mortgage standpoint, we're really only 3 years old. In fact, today is our 3-year anniversary of our brand launching. It's kind of fun to celebrate. And I get to share that with you today. So, we did about $260 million last year. So we're getting out of the gate, but we have grown a ton over the last 3 years. Our model is basically that we sell most everything that we do, although right before COVID hit, 2 weeks before, we launched a servicing platform with portfolio products. So it was kind of an interesting time to do that, but that is one thing that I think really sets us apart. But the most prevalent thing that we talk about today is our Right By You guarantee, and that's our guaranteed on-time closing. We pride ourselves on a great customer experience, and that Right By You guarantee sits at the heart of that.
Awesome. And Melissa mentioned 3 years since the bank brought Melissa on to create the mortgage division, essentially. And one of the things I love about your perspective, Melissa, is you have background working in management roles for independent mortgage banks, and these last 3 years for a community bank. So excited to get your take on all the latest that's happening in the mortgage industry. And let's start with great news. The FHFA almost immediately after Calabria was given the heave-ho, waxed the 50 basis point refi fee. Nothing to not like about this. And, great to hear that this new iteration of the FHFA, listening to feedback and understanding the positive impact this is going to have on mortgage lenders and also borrowers that want to refinance.
Absolutely. It's super exciting. I think we got some cheers from 200 miles away from our loan officers that made it all the way here as that was announced. So it is very exciting. I think the most exciting thing is for our borrowers and the impact that can have on them. Because this was something that was added to pricing as soon as this came out. And so there's some people that it didn't make sense to refinance then that it might make sense to refinance now. And so it is definitely exciting to see. I'm also excited to see the change happen so quickly after Sandra's kind of stepped in and taken the lead. She made a comment about this being her kind of first initiative to really further homeownership rates, for some underserved communities. And I think that's going to be a big push of the FHFA in the future too. So it's kind of fun to see some of those things starting to come to fruition and a focus on that as we start into kind of a changing market post-COVID.
Yeah, it was one of the craziest things of the mortgage related elements of the pandemic was when they implemented this fee, it was almost no notice. Lenders had huge pipelines of refis that all of a sudden they were getting whacked an extra half point on. And nobody, was feeling bad for the mortgage industry last year because obviously volume was good and margins were good. But people always forget, especially government, when the mortgage industry is having a good year. This is such a cyclical industry that, with at times next to no margins, that it's performing such an essential role for the housing finance system in America, for housing, for the economy in general in America. So it was nice to see. I think they implemented this effective August 1. So now we kind of get the flip side. Lenders have some refis in the pipeline that they're going to make an extra half point on, and that's a good thing.
Absolutely. Well, the whole premise behind it originally was also kind of shocking, right? The adverse market, it's no longer there. Forbearance rates are kind of dropping as people have less of a need to go into forbearance. We're seeing the job market continue to improve. I mean, the layers of risk that were there originally that were kind of touted as the reason behind this extra fee was, it's very clear that is no longer there.
And the timing of it also good from the standpoint that mortgage rates have dipped back down a little bit here. Lowest levels for the 30-year fixed rate mortgage rate since February, dipping back down into the low twos, depending obviously on credit and some other things. Just anecdotally and talking to some of our members, there has been a little pickup in volume these last couple of weeks. Not sure if you're seeing the same. This only helps. I mean, there's been so many refinances the last year, the pool of refinanceable people. You keep hearing the stats on how many are still out there, but real world, it's eroding. So, 50 basis points, the equivalent of about an eighth in rate. It really helps. There's got to be, many borrowers out there where that extra eighth makes it worth refinancing as opposed to not.
Absolutely. Seeing a drop in rates obviously increases volume and makes all of the lenders on this call happy. So it is exciting to see it. In fact, I don't really think we're going to see much of a change. I mean, we always are, changing a little bit, but for the rest of the year, I think we're really going to stay relatively flat. So I think the opportunity is going to continue to be very strong as we continue to go through 2021.
If you think about it, you go back a year from now, we were, really still in the heart of the pandemic. 30-year fixed rates had just dropped down into the high twos. A year later, in 30-year fixed rate, 10 basis points lower today than it was a year ago. Not many were predicting that. I think last year, like almost every single year in the history of the mortgage industry, all the economists predicting rates to slowly go up into the high threes. I mean, honestly, every year for the last 25 years. But here we are, with rates 10 basis points lower than they were a year ago when we were still in the thick of things. So, again, it's good for our members and companies like Right By You, but good for the American economy. And kudos to the Federal Reserve for their role in helping keep mortgage rates low.
Yeah, as long as they keep buying mortgage-backed securities, I mean, rates are going to stay low.
I give them credit. They got the pedal to the metal. I mean, every Fed meeting now, they're getting peppered with questions like, why the hell are you buying so many mortgage bonds? Like, rates are low enough as it is already. There's this madness of surge for housing. And they're just like, and, you get it. The impact, I mean, think about it. Somebody refinances an eighth in rate. If it's the 50 basis point fee going away or just keeping rates low, I mean, the average refinance is putting hundreds of dollars back into the pocket of American consumers that they could put back into the economy. So
absolutely. And if your houses are appreciating at the rate that most of ours are appreciating at too, you've got some buyers that may have had MI before that don't have MI, so that it can be kind of a exponential benefit for some people. To go through this process today. So it's definitely exciting. Again, at your point of, nobody really predicted this last year is super true. It's fun to see the forecast kind of change right now. And Freddie Mac just came out with a new forecast that is talking about really relatively year over year steady volume and originations from 2020 to 2021. There's, maybe a 4% decline, which in the grand scheme of things is relatively steady, but I don't think anybody saw that coming either. And, a big portion of that is the people that haven't gone through the refinance process or are purchasing like crazy right now. And I think most of the volume that we've seen, and my kind of peers in the industry that I talk to, there's a drastic shift in percentage of purchase volume that's coming through right now.
Yeah, 2020, an industry record, just over $4 trillion in mortgage originations. Remember talking on this show and, with others late last year. The projections for this year were 3.1, the initial projections trillion. So down about a quarter. People expected refis to be cut in half, purchases maybe to go up slightly. Fast forward now, we're in the middle of July, and the projections, they started to creep up 3.3, 3.4. And now you see Freddie Mac and others coming out and saying, hey, this year is going to be almost as good, if not as good as 2020. You just mentioned it. Freddie Mac just revised their origination projection for 2021, 3.9 trillion.
Yeah.
Which would make it, I believe, the second best year in the history of the mortgage lending industry.
Yep, exactly. It's just incredible. But so Fannie Mae has also joined the kind of bullish outlook on the rest of 2021, by the way. But Freddie Mac's recent release, I mean, the percentage of purchase to refi continues to obviously grow really heavy on the purchase side, but refinance is holding strong. And I think that's what's holding that volume really high. Just the opportunity for people to get through the process. And, like we talked about just a minute ago, that adverse market fee hopefully will help, drive that throughout the rest of the year too.
Absolutely. Especially if we can get a little bit more of a tick down in the 30-year fixed rate. Maybe if we see some of the inflationary numbers ease, you see that 30-year fixed rate number get down in that 2.6, 2.7 range, that extra eighth in rate, the elimination of the 50 basis point fee. You could see another little, not refi boom or wave, but spike to be certain, no?
Yeah. So the previous prediction of rates going up to like 4%, it's still in there, by the way. It's like in 2022, 2023. If you keep reading far enough, they still have it. It's just a matter of timing. But it's great for our economy. It's great for our customers. It's great for our industry as a whole. I definitely could see this leading to a stronger outcome for refinances. I mean, frankly, the previous predictions of it dropping as much as it was predicted to drop didn't account for people pulling cash out for renovations and, potentially needing to shorten terms later on. I mean, there's always a need for refinances. There's always, a healthy mix of it in your overall pipeline that doesn't necessarily fully ever go away. So I thought their previous predictions were actually quite bullish and didn't quite account for those sort of things. I mean, people use equity in their homes for a lot of things. Some use it to pay, not right or wrong, pay for college for their kids, or can pull it out to do renovations like I just talked about. So those things are always going to be a part of our world. It's fun to see it at the level that it is right now for us for the rest of the year, I think, until 2022 when those rates go up to 4% again, like Freddie's predicting.
Maybe, right? Yeah.
Yeah. No, I'm saying that facetiously.
This is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week, joined by Right By You Mortgage's Chief Mortgage Officer, Melissa Langdale. To some less rosy news, Melissa. This week, the National Association of Home Builders CEO Jerry Howard testified before Congress, pleading for some help from Congress to address what is really a worsening home inventory problem in America. If you look at some of the recent stats that have come out, building permits, which is the indicator that tracks the start of the home construction process for a builder before shovels go in the ground, way down, lowest numbers in a while. New applications to have homes built down 24% year over year. The average new build home price up 18% year over year. Still some issues with the supply chain, a lot of issues with labor for home builders. Some of the supply price issues are easing a little bit. So NHB CEO this week pleading with Congress to help fix the building material supply chain, improve the low income housing credit, tax credit, and to really just, a plea to kind of reformulate the current home ownership tax incentives. Your thought on just the new construction inventory issue in America, what you're seeing in North Carolina and other parts of the market and people you're talking to?
Yeah, his plea, like you said, was trying to ease tariffs on Canadian lumber. So hoping that would help with our supply chain challenge right now. In our world, the extra layer for us to pay attention to is his plea for a first-time homebuyer tax credit. There's a kind of push for having some level of incentive or some benefit for buyers that are going through the process right now. So I can see maybe a consideration for that. I mean, the Biden administration talked about that in some of their campaigning before they were really elected. So, and just knowing this administration, I could see them being supportive of some level of tax credit. The structure and what that looks like, I'm not sure, but that doesn't necessarily fix the skilled labor shortage, the supply chain challenges that most of our builders are going through right now. But the skilled labor shortage has really been around for quite some time. It's just exacerbated now, right? And in 2008, when we went through everything that we went through back then, a lot of those skilled workers found other professions, and most of our builders are really struggling to find plumbing and HVAC and some skilled labor like that. So I'm on the board for the Wade County Home Builder Association, which is one of the largest HBAs in the country, and we talk a lot about skilled labor and how it's just so important, and that organization has partnered with local schools to help fund scholarships and those sort of things for individuals that want to go through those programs, just as a way to try to help gain some momentum in individuals being interested in and being supportive of those careers. So, the labor shortage is a piece of it, supply chain is a piece of it. All those things add to the cost of the home, which you just talked about, that affordability being a significant concern. Layer that on to just regulatory costs. I think in that same kind of statement, he made the comment that about 25% of a home builder's price that they offer on the home is due to regulatory burdens. And it is a significant cost, impact fees and what that does to the overall home price. So our builders are faced with a pretty significant challenge in front of them, and creating affordable homes at this point is difficult, without some help. Hopefully the tariffs will help in a little bit, but we're going to have people be interested and be excited about going into construction as a career as well.
Yeah, many valid points. And it just seems like something's got to happen here in terms of intervention from Congress. Wall Street agrees. The investing community, myself in this class, betting on the home builders right now. Home builder stocks have taken a hit these last couple months just for all the reasons you just talked about. But these last couple of days, some pretty big spikes on some of the home builder stocks after the testimony of the NHAB's CEO to Congress, betting that something is coming. in the way of relief for home builders and also for those that want to buy newly constructed homes and, hopefully to help aid builders to build more affordable homes. More affordable homes aren't being built in America, and which is a problem in and of itself, forgetting the inventory issue. So feels like something's coming here, just given the Biden administration and this Congress's, I think, consistent comments and commitment to housing and affordable housing issues.
Yeah, I think, one layer that we're kind of missing in this discussion is around available land to develop. And what that process looks like. I mean, if somebody's looking to go out and buy land today that's raw land, you're 2, maybe 3 years from being able to have a community on board. And that time frame isn't helping our inventory shortage, right? It's it's not going to get there fast enough, and we're underbuilt right now by about 5.5 million homes. So our demand is significantly higher than what our builders are able to get to right now. So if we don't have some relief for them, it's not going to help them meet that demand.
Yeah, it feels like home values, they were just, we talk about on this show every week, just skyrocketing like month over month. And some of these, 30 bids over asking, it feels like that's starting to settle down a little bit. But there's no short or medium term fix to the inventory issue. It feels like that the demand to purchase homes is not going to go away. That right now, I think there's maybe my just general sense is there's a lot of people out there like, man, things got a little too crazy. Like I'm not willing to pay what is going on right now. So I feel like things have subsided a little bit, but those are still interested buyers of homes. The pandemic in general, it really feels like has just increased the value in American people's minds of a home, and a lot of people that want to upgrade or move. So, I think if something is not done here, we could be in a pretty serious inventory crisis, as soon as this fall or winter, and not just the annoying problem that we keep talking about every week.
Well, I think we're almost on the edge of that, honestly, Rich. The thing that is layered in our world today that wasn't layered there in our kind of pre-COVID world is people have choices. They can work remote. They can work wherever they want. They can work at the lake. They can work at the beach. They can, they can travel. They can, they have choices where they want to live. They don't have to live in this, kind of 2-mile radius or 10-mile or 30-mile or 50, radius of their actual workplace anymore. And so I think that's going to continue to drive some of our purchase originations and continue to drive our market. I think, one of the articles that came out that you started to talk about suggested that home sales have started to cool down a little bit. I wonder if that really is a result, though, of our inventory shortage and less a result of the demand that's out there. Because we still see exorbitant due diligence money. We've seen one come through at $80,000 and $100,000 in due diligence money, which is the sellers, regardless if it closes or not. And so it's, there's big things like that continue to still happen in our marketplace. So I know we're not alone. There definitely could be some cooling of things. We're just not seeing it on our side.
Feels like a pause. It feels like, Joe, I want to buy a home in America right now. It's just like, man, it seems like, that's not in the industry. General thought is like, things have just gotten a little bit too crazy. I'm going to wait a couple months and values are going to come back down. But to your point, there's nothing in the rates are going to stay low. The demand is going to stay out there. The inventory problem is only getting worse. So it feels like almost like a little, because you mentioned it, I think, we've seen new home sales dip, they fall from April to May and May to June. That never happens in our industry. Almost every single year, we see home sales increase as you get into April and May and June. And now we're seeing declines. But it feels like a pause. And I could see home sales shooting up as we get into August and September, and values getting even crazier than what we were talking about a month or two ago.
Yeah, I don't disagree. I think we're, if it's out there, and again, we unfortunately, I live in my happy bubble in North Carolina. But we haven't seen it as much, but I think if it's out there, it can't be long lived with rates as low as they are, and people having a choice of where they want to live. I just feel like there's just an opportunity to continue to have home sales grow.
This is the last week in Mortgage Today. I'm Rich Swervinsky with the Mortgage Collaborative. This week joined by Right By You Mortgage Chief Mortgage Officer Melissa Langdale. Got about 3-4 minutes left with Melissa. Melissa, want to turn our attention to just cybersecurity in general in our industry. There was just a pretty serious ransomware attack on a fairly sizable title services company that had all their data stored in the cloud and was breached by a ransomware attack. So many transactions in the mortgage industry. This last a record year, and we're in the middle, over halfway through what could be the second biggest or maybe the biggest year in the history of the mortgage industry. So much freaking borrower non-public personal information in the cloud. That alone, it has to make our industry a huge target of hackers. And we're starting to see news of breaches. As somebody that runs mortgage lending for a financial institution, I talk about like the bank's mindset about that, your mindset about that, and how you see things playing out in the cybersecurity and breach space.
For this reason, as an organization, and I'm sure we're not alone in this, we don't have much stored in the cloud. But as an industry, I think banks are a little more trepidatious about operating in the cloud as well. The company that had this ransomware attack was they provide basically IT services for title companies. All of their basically email, IT, and network infrastructure, and for like 42,000 users in the title industry. So, this is just, it's huge. And those individuals, those settlement agents and title companies that rely on them are still, as of about 2:00 this afternoon, we started this call, still out of luck. They are completely shut down from being able to operate. So it's interesting. These cyber attacks are supply chain oriented, right? You had one earlier on oil and meat, and we're starting to see it in our industry. This is not something that's going away. This is something that our organization should be prepared for, and the one of the solutions that was mentioned in that article suggests that kind of dual cloud hosting would be a good solution. So you kind of have a backup of the backup. So it's harder to steal and hold hostage that data when you already have it in another place, right? And so, that may be a solution for a lot of our industry to consider. That makes sense in my non-IT mind. But that's, it's going to be something that our industry, I think, is going to have to be very focused on.
Absolutely. Melissa, always enjoy the conversation. Thank you so much for once again taking the co-pilot seat this week here on the Last Week in Mortgage Today.
Yeah, absolutely. Thanks for having me.
And to our viewers / listeners, thank you for taking 30 minutes out with us. We are here, same place, same time, every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage Today. And of course, as always, this broadcast will be uploaded to our YouTube page and released as a podcast, where I know a lot of you listen and watch as well. So until next week, have a great rest of the week, everyone. Take care. Bye, Melissa.
Bye, everybody.